Welcome back. Futures are in the red this morning, indicating a decline at the start of trading after Federal Reserve Chairman Jay Powell wrapped up his 2 days of Capitol Hill testimony. The Dow Industrial is right now down 108, the Nasdaq down 105, S&P down 22. Powell speaking before the Senate Banking Committee yesterday. Similar commentary as the day before when he spoke with the House Financial Services Committee. Yesterday he said that the future of rate hikes will continue and that looming inflation remains. Watch.
We are committed to getting inflation under control, and the strong majority of the committee feels that we're close, but there's a little further to go with rate hikes. We want to get to a level where we're confident that inflation is and will continue to move, is moving and will continue to move down to 2% over time.
Joining me right now is Banríon Capital Management CEO Shana Sissel. Shana, great to have you. Thanks so much for being here. What was your takeaway from Jay Powell?
Nothing surprising to me. He has been commenting for months now that the Fed will continue to remain hawkish because they really want to make sure inflation is under control. They have said that they will absolutely be willing to put the economy into recession. And so nothing he said was particularly surprising, at least not to me.
So what does that mean for investment portfolios today? Do you want to keep buying what's been working, and that's big tech, with the Nasdaq up 30% year to date, or do you want to change the way you're allocating capital given the impact of higher rates on the economy?
I think you do want to think about how do you position your portfolio in a decreasing liquidity environment, because that's essentially what increasing rates is doing, is taking liquidity out of the system. So you want to focus more on stocks that will benefit in that type of situation. Those are things like materials, energy, healthcare, industrials. So those are the names I'm really focused on. Now, obviously, there's some tech headwinds to the technology sector and specific areas. For example, there is nothing that's going to change this trend toward AI, machine learning, cloud computing, but you want to be really selective there because increased rates and decreased liquidity means that it is going to choke off growth, and growth stocks like tech stocks are not going to benefit in an environment like that.
Well, do you think we will go into recession this year?
I don't know about this year. More and more it's looking like first quarter of 2024. And I'll be the first one to say that I really thought we'd be in a recession by now. It's just there's so much excess liquidity in the system. And when we had the mini banking crisis back in March, the Fed and the Treasury actually put more liquidity in the system. And then coming into the debt ceiling, there was more liquidity put in the system. So we've only seen liquidity start to drain from the system in the last, 30 days, really. We still have a long way to go before we really start to see the contraction in the system in terms of this excess liquidity. And that is what will push us into a recession. And the strength in the job market has also kept our economy a lot stronger than a lot of people expected. But again, we're starting to see signs of weakness in the employment market, which suggests to me that we're probably in the fourth quarter of this year or first quarter of next year going to start to see a recession-like environment.
Yeah, it's interesting that Powell said we don't see any rate cuts anytime soon. Isn't that one of the main reasons you've seen that huge rally in stocks first half of the year? Even as it's not just the U.S., but other countries are also raising interest rates. We saw the Bank of England have a surprise 50 basis point hike yesterday. The European Central Bank raising rates. The global banks of the world are hiking. Turkey's central bank also hiking rates to 15%, almost doubling it from 8.5%. Shana, your reaction to what's going on across the world?
I'm not surprised, although I will say the 50 basis point hike by the Bank of England was surprising. However, inflation has been sticky globally, and it's sticky here. It has come down. It absolutely has come down. Every quarter it has come down. The question is, will it hit that 2% mark? And that is unlikely. There's just too many drivers in the system that are keeping it up. The cost of housing and the cost of just having a roof over your head is expensive, food costs, things of that nature. So it is going to stay sticky high, especially if the employment markets stay really tight and the Fed really is focused on, quote unquote, breaking the job market. It's not a popular stance, but there really needs to be some flexibility and some loosening in the employment markets if you really want to see inflation and many of the drivers to inflation come down.
All right, we will leave it there. Shana, good to see you. Thanks so much.
Thank you.
Shana Sissel.